Hey, everybody. President Biden's recent budget proposals for 2025 reveal just how much the money game is changing. It's changing right under our feet. Right? And this could be dramatic changes that'll negatively affect your business and your wealth accumulation. And we're going to go through five big changes that I saw as I was going through the documents online. It's available. You can read them. This is for sure. The times they are a changing, right? The federal debt is out of control. There is no end in sight for this debt cycle. We are paying, as a country, over $1 trillion a year just in interest payments. I mean, things are not looking good. Some people estimate that we've got over $200 trillion of unfunded liabilities, stuff that's not showing up on the books. And experts are predicting income tax rates may need to double by 2030 or 2033, something like that. So this is serious. Like, this is not a joke. And we can see in these budget proposals, just kind of read the tea leaves. Like, this is where things are going. And so that means we got to change. We got to change because the rules are changing. So that's what this video is all about.
Huddle up, team. We are John and Tara Thorman, your money coaches for entrepreneurs, business owners, and the self-employed, and everyone who wants to be one. Once again, the government is looking to change the rules of the money game, and in this video, we're going to explain what is happening and how you can protect your wealth.
That's right. And guys, guess what? Wall Street is not the solution.
No.
Okay? We've got to think beyond the Wall Street box, to get outside the Wall Street box and look at what opportunities are out there. And, Ray Dalio, who is the founder of the largest hedge fund in the world, he says that the holy grail of investing is to have between 10 and 15 non-correlated asset classes in your portfolio. Wall Street is like maybe one of them, okay? Also, Tony Robbins, in his new book, The Holy Grail of Investing, he talks about how the wealthy people are investing in private equity and private real estate and private lending, and that's where the bulk of their money is being invested. It's not invested in Wall Street. I just watched a video today, actually, from Mark J. Kohler, and I really appreciate him as a CPA and attorney. And he mentioned in this one video that the family offices, those with over $10 million of assets to invest, they are investing them. 80% of the money is invested outside of Wall Street. Again, back to the private portfolios of private equity, private businesses, real estate deals, syndications, private notes, crypto, all these different things. But 80% of the portfolio is outside of Wall Street. And for most people, that might blow your mind because we've been conditioned and trained to believe that's the only place to invest our money, right? Well, it's not. There's a whole nother world out there. And I think we really got to start capitalizing on it and take advantage of it. So here are the five big things that I saw in the proposal. Are you ready?
Number one is to increase top individual income tax rate to 39.6% on income above $400,000 for single filers and $450 for joint filers.
Yeah, and this is set to be effective this year in 2024, okay? Now, what's interesting here, the current tax brackets, okay, the current rate is 35% for between $243,000 and $609,000. So the higher rate will affect more people because the current bracket goes up to $609,000 at 35%. And then it's 37% for those over $609,000. So they're going to change the brackets so that more people are going to be at a higher tax rate. And that's a problem. And right now, the tax brackets are set up through the Trump tax reduction that happened in 2018. It's a sunset provision because it wasn't a permanent situation. So it will change in 2026. It automatically reverts back to what it was in 2017. I would plan on the reversion, but this is a negative change to the reversion. Like I said, more people will pay at a higher tax rate above the $400,000 or $450,000. Number two, what's number two, babe?
To tax long-term capital gains and qualified dividends at ordinary income tax rates for taxable income above $1 million.
This is humongous. This is a really big deal.
Yeah.
The government is looking to take away the incentive for us all to be investors, to take on some risk. You know, right now, capital gains tax is either 10% or 15% or a maximum of 20% based on your income. And the same with qualified dividends. Man, if they change that, that's I don't know what that's going to do. That I think could be a dramatically negative impact on investment and the growth of our economy when we take away that incentive for people to take on risk and try to grow a business, grow the economy. Now, it does affect only those people that are earning over $1 million, but I mean, that can change all the time too, right? I mean, I don't like the trajectory. I don't like where this is going, and I think it's a bad idea.
And number 3, to limit retirement account contributions for high income taxpayers with large individual retirement, IRA balances.
Yeah. So the concern here is that this could eliminate
the Roth conversion.
The Roth conversions, our ability to take traditional IRA money or traditional 401k money and convert it now when we're in a historically low tax rate environment. Pay the taxes now because you're going to pay them at one point, but pay them now at a historically low rate and then defer the taxes forever. Like it's tax-free forever after that point, right? So I want to encourage you, if you've not done Roth conversions yet, if you've got a lot of money in a traditional 401k or IRA balance, you really need to take a look at what you can do to move that, to do the conversion and put it into a Roth. Especially before, you know, the sunset provision on the current tax law changes and they go up in 2026. You want to take advantage of that and max out that 24% tax bracket, okay, so that you pay taxes on as much of that money you can convert as possible before you bump up into the 32% tax bracket.
Number 4 is to eliminate step-up cost basis.
Yeah, this is really dramatic and significant, right? You know, like if you have a stock portfolio or real estate or business assets that at the time of your death, you currently are allowed a step up in the cost basis. So that means whoever's inheriting your money gets it at the stepped up current market value and not the original owner's cost basis. So example, let's say you buy a stock and it's $100,000 that you invest in the stock and you hold the stock for 20 years. Now it's worth, $1 million. Well, the capital gain there is $900,000, right? People that inherit the money get the step up of cost basis, not the $100,000. Their cost basis is now $1 million, so they could sell it, the $1 million, get the cash and owe no tax. This is a huge way to be able to transfer money between generations and minimize tax liability. Well, if this goes into effect, you're going to lose all that ability.
Wow.
So again, not a good situation when you're trying to plan out how you can maintain wealth in your family for generations.
And number 5, limit your 1031 like-kind exchanges to $500,000 in gains on real estate investments.
This is another dramatic change, right? You know that 1031 exchanges are a great way to defer taxes and allow you to compound the growth of your real estate investment portfolio because you keep all the money. You don't have to pay taxes on every transaction, every sale. So if you've got $1 million of capital gains in your real estate, you're able to sell the real estate, do the 1031 exchange into another property and not pay any tax on it. It helps you buy a bigger investment property so you can accumulate more assets at a higher value and more cash flow. So not a good idea here in my mind. This will dramatically affect a lot of people because they've been counting and planning on these, provisions to avoid or defer or eliminate taxes in their financial life and transfer that wealth to their kids and their grandkids without paying tax on it. Like this is massive changes.
Yeah,
and
a big one.
And the government will say, oh, we're going to do this. And then we all respond and say, oh, that's awful. And they say, oh, okay, maybe not so much. And they drop it a little bit. And then we think they're doing us a favor. Wrong. Okay. They shouldn't have suggested changing it in the first place.
Right.
So I want to encourage you right now, if you haven't, it's time to really look at what can you do knowing that this is like the trajectory. The government's coming after your wealth. They're coming after your assets. They need revenue. So what can you do to change your game? Call some different plays and reposition things so that you can minimize the effect. You may have until 2026. You may have a little bit longer for some of these things, but we got to look at what can we do to make some changes. So here's my idea. Okay. I want to encourage you, number one, look at setting up a self-directed Roth 401k and max it out. Especially, uh, like I said, if you're self-employed and you don't have any employees, this is a humongous advantage and opportunity for you. And if you're under 50, it's possible to structure this in a way that you could put as much as $76,000 per spouse into this in 2024.
Wow.
And if you're over 50, you can structure this. It's possible to put away as much as $84,500 per spouse into this and have that grow then tax-free forever. I mean, it's unbelievable. And the best part is you're not limited to Wall Street investments. With a self-directed Roth 401k or self-directed Roth IRA, you can invest in things that you know best and that you're most passionate about, and that will allow you to make way more money, than the sanitized and reduced, opportunities on Wall Street. Number two, take the time and complete your Roth conversions, right? If you haven't done it yet, get on it. Like, the window of opportunity could be closing here. I don't know for sure. Nobody does, but it's not looking good. So take this time and complete your Roth conversions. And remember this, right? It's short-term pain or short-term discipline for long-term gain and long-term freedom, right? That's my encouragement here. Like, let's not delay on this. I think the window's closing. Number three, look at max funding a self-directed HSA account, a health savings account. You do have to have a high deductible health plan, but if you do, as a couple, as a married couple or joint filers, you're allowed to put $8,300 in 2024 into this health savings account. Now, you want to do this for three reasons. One, you get a tax deduction on the $8,300. That's great. Two, it grows tax deferred. And three, the money comes out tax free when you use it for medical expenses. Okay. Now, you can pile money into this and you can invest it in a self-directed account, so you can put it, where you know best and make way more money than what you can find generally on a Wall Street portfolio. But you can contribute to that up until you start taking Medicare. Typically, that's going to be 65, but we do not really appreciate the enormity of out-of-pocket healthcare expenses that you're going to incur during retirement. Like, I think the average person could expect a couple $100,000, $300,000 in out-of-pocket medical expenses throughout your entire retirement. That's just a boatload of money. So stuff that HSA full of cash and have that compound over the next 10 or 20 years, and position yourself, to really have the best quality of life and minimize your taxes. But then number four is max fund specifically designed cash value life insurance contracts, so that you can minimize your insurance costs but maximize the amount of money that is saved inside those contracts, because you can access it tax-free. So there's living benefits, right? The good policies are designed with living benefits to give you access to the insurance benefits if you become critically, chronically, or terminally ill. You can accumulate tremendous savings balances in these contracts, and it's all tax-free. It's accessible to you on a tax-free basis, and then it'll help you with wealth transfer, because at the time of your death, whatever's left in the insurance amount generally goes tax-free to your beneficiaries. And man, they could really need it if these tax changes go through. One of the big issues, honey, with estates, when somebody dies, is there's a lack of liquidity, right? Your money's tied up in assets. It's tied up in the business. It's tied up in real estate. It's tied up in other things, and it's not liquid. And the beneficiaries need cash. They need liquidity. And so having really well thought out life insurance strategy will remove any of those burdens. So guys, things are changing, and I want to encourage you to change. We got to pivot. We got to plan ahead. We got to take advantage of the opportunity while we can, because you don't know when that window is going to close for like permanent, right? So please, we would love to hear your comments and thoughts on this. Like this video and drop a comment, and be sure to subscribe to the channel so you don't miss another great video on how you can achieve financial freedom faster so that you can enjoy it longer. All right, everybody, have a great week. We will see you on the next video.